It is that time of the year when your accountant in your office is asking you for proof of investments so that he would know how much tax to deduct in those last 3-4 months. For people who are in business, their tax consultants are urging them to do the investments so that they would know how much tax payable would be payable towards the end. And then there is a mad scramble to invest so that you can save on some taxes. So we start focusing on the tax saving part and buy any investment that can come into our focus. Now, for this particular discussion, I am talking more on life insurance and the pension plans. Now, life insurance and pension plans are products which are designed for specific purpose. Life insurance is covering the risk of a person dying too early so that his dependents are protected, at least financially. Pension plans are products which are protecting the person who's living too long so that he doesn't run out of money. When these two products are having such specific purpose, why are we mostly buying them so indiscriminately? For example, in life insurance, the product to buy is the term insurance, where it specifically covers the risk of dying. There is no investment element in it. So the premiums are cheap, and you can buy the amount of insurance that you really need. If you buy an investment oriented product, you cannot get adequate cover because the premiums are high, and the product is such that there are too many expenses, hence it is inefficient and you will not make a decent return on it. So when you are buying a life insurance, focus should be on the insurance cover that you get and not the tax benefit you will get from the premium you pay. Anyway, for term insurance, whatever you pay, that premium will qualify for tax benefit. Then we come to the pension plans. Now, pension plans people have been using in such a weird manner. I'll give you an example. A few years back, there was a section in the income tax called 80CCC. Now, under this section, you could invest up to rupees 10,000 in a year in a pension plan and qualify for tax benefit. Now, remember, it was only 10,000 rupees. Anything paid above 10,000 rupees does not qualify for tax benefit. So people, depending on the tax slab, would save 1,000, 2,000 or 3,000 rupees by paying this 10,000 rupees. And they would still go ahead and buy these pension plans. Now, pension plans are for creating a corpus so that that corpus that gets accumulated at the end gives you an annuity. Now, what sort of annuity are you going to get with a 10,000 rupees premium, even if you have a policy for 20 years? At the end of 20 years, the corpus is 2 lakhs, a little bit more with the investments added, say 3 lakhs even. What sort of annuity are you going to get on 3 lakh rupees corpus, and that too after 20 years, where inflation actually has such an effect that that 3 lakh corpus itself hardly means anything. So what you have to focus on in a pension plan is the annuity that you really need, and that annuity has to be calculated depending on what are your expenses today. Then you have to look at how much you can save yearly for that, for accumulating that corpus. And at the end of that period of savings, which could be timed with your retirement, whatever corpus comes to you is the retirement corpus. And that has to be substantial for it to have any meaning for the annuity that you purchase. So in conclusion, buy the life insurance plans or the pension plans for the reason they actually exist. Do not buy them for saving taxes. I'm Yogin Sabnis and you're watching the VSK YouTube channel. Thank you for watching.